Greetings from Robare and Jones Wealth Management. My name is Jack Jones. I'm the managing partner, here to give you some quick insights as to kind of what to look forward to the remainder of the year and kind of what we're paying attention to. Before we do that, 2020 has been a truly unusual and challenging year, to say the very least. We want to thank our clients for the trust and confidence that they placed in us during this difficult time, and tell our value clients how much we miss seeing you in person. We wanted to share some information with you. First, we wanted to thank our clients who participated in our event on November 21st. It was truly a great event. For those that participated, there's also a video of this that's a recap on our website. We had over 125 cars come by curbside, both donate goods for a food pantry that I'll speak about in a second, and also pick up some treats from us. So even though it was a very short period of time, a couple of Saturdays ago, it was great seeing you in person. And because of your generosity, both in the donated goods and because of the trust and confidence that you placed in us, we were able to donate over 2,000 pounds of food to a local food pantry. And it's just kind of a reminder as to how acute and close the need for this type of ministry and nonprofit is during this time of year. As we were unloading items on the Monday following our November 21st event, there were people already in line to receive food that so many in this area, their families need during this time. So I say that just as a way of thanking you, our valued clients, for, again, entrusting us and allowing us to do good in our community, and also directly supporting through your food donations and making this just a very successful event. So thank you very much for that. I want to speak to jobs. You probably know that there was a jobs report that came out Friday. The unemployment rate ticked down to 6.7%, but for all the wrong reasons. The participation rate went down, therefore driving the unemployment rate down. So this was a pretty negative jobs picture on Friday. Only 245,000 jobs created. And as kind of a summary, what's happened over this period of time is you'll see that 22 million jobs have been lost and only about 12 million regained. And you'll see, as you might expect, that 58% of those job losses are in leisure and hospitality that have just been struggled so much during this time. This won't surprise anybody that there's been a lot of volatility this year. In fact, last year there was only, in 2019, there was only 7 days where the S&P 500 moved up or down by more than 2%. This year, we're on pace for that to be 56 plus or minus 2% days. I will say, as a financial market item, when we did this update in October, we asked the question, was a bad October good for stocks? And we didn't know at the time that November would be the best month in the S&P 500 in its history. So the answer to the October negative, down about 3%, was a resounding yes in the very short term. And again, the S&P 500 posted its best November in its history. Obviously, the S&P performance by sector is widely disparate, with online retail and information technology doing the best return-wise, and things like airlines and energy doing the worst. And what you'll see by virtue of tech being so dominant is that technology is now 40% of the S&P 500. Now, the counterpoint to this being a risk item is that their contribution to EPS is also high. So you have to consider both of those. Back when the dot-com bubble burst in '99, technology was a 2-to-1 weight to their contribution to EPS. So one of the things to consider, yes, tech is now 40% of the S&P 500 as of the end of November, but it's also an outsized contributor to forward EPS. And one new name that you'll see in the S&P 500 in December is Tesla. You'll see the names in the top 10 in the S&P 500 by market cap. So you'll see that Tesla will be a top 10 company in the month of December. Interest rates, this is a mountain chart we talk about a lot. The bull market in bonds that began in '81 and has now gone for almost 4 decades, with rates now as of the end of November being, sub 1%. And the reason we bring this up is this acts as a look at valuations of all other types of assets, because all other assets are compared against, well, what can we get in terms of yield or interest in a money market account, cash account, CD, things of that nature. So the fact that interest rates are so low, which is a negative impact on the saver, it's positive for the borrower, but negative for the saver, means you have to consider all prices and relative attractiveness compared to this very low rate and interest rates. Not surprisingly, there's been a buildup of cash this year with elevated risk levels due to the coronavirus and elections, and many of those risks still remain, even though, again, November was the best S&P 500 in history. What this shows is that, almost or over $750 billion have flown into money market funds so far this year. The question is, will it remain there? Nobody knows the answer to that question, but again, per the prior slide, money market rates are very low. So the relative attractiveness of money market or money being in cash, it may feel good for the short run, but likely some of this, as represented by flows thus far this year, is temporary. So again, hopefully that's given you kind of a brief recap of kind of how we're seeing markets. Again, we want to thank our clients for the trust and confidence that we've placed in us, or that you've placed in us during this very unusual year. Should you need to reach out to us for any reason, anything specific to you, feel free to do that. We are here to serve you, our value clients. Thank you for listening to our December monthly market update, and we look forward to seeing you in person soon. We want to also wish all of you a very Merry Christmas and a Happy New Year.